are faced with different decisions. And Lord, this morning we ask that you would be with people who need to know you as their Savior, and that you would be with people who aren't as fortunate as we are. Lord, I pray that everything we do is pleasing to you, and that we look to you for guidance and direction. This is our prayer in Jesus' name. Amen.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Any additions to the agenda? If not, we'll open for a motion to approve.
This is the office.
This one,
Fair.
right? This
Yeah.
one.
Okay. So moved.
Second.
Moved and seconded. Any discussion from board members? Any public comment? All those in favor?
Aye.
Anyone opposed? And we'll move on to the minutes. I believe they were sent out early for everyone to review. So we'll open for a motion to approve the minutes.
So moved.
Do we have a second?
Second.
Any comments from board members? Any public comment? All those in favor? Anyone opposed? Okay, we'll move into the auditor report. I believe that's going to be Tricia
That'll be Mike.
and Mike. Welcome. And the tall man.
Good morning.
Good morning.
It's a pleasure to be here this morning. For the record, my name is Mike Carter. I'm a principal with Clifton Larson Allen. And with me today is Tricia Floyd. Tricia is manager on your audit. And Tim Jiggle. And Tim's the AV guy back there. So the tall guy. So, Tim also worked on your engagement, on your audit. So, yeah, it probably would help to do the lights down a little bit. This morning, we're going to try to just hit the high spots on the audit, but if we go over something that you have a question on, please feel free to stop us. I believe that Tricia presented a draft at last month's meeting, so hopefully you've had a chance to look it over. On the first slide is just the CYA stuff, just to remind you that this is highly summarized information, and that needs to be taken in consideration with the full financial statements. One of the reasons that you hire us is to plan and perform an audit so that we can render an opinion on the financial statements as to whether they are fairly stated in accordance with generally accepted accounting principles. And on the next slide, this is the opinion paragraph, which is on page 2 of the financial statements. And it reads, in our opinion, the financial statements referred to above present fairly in all material respects the respective financial position of the governmental activities, the major funds, and aggregate remaining fund information of the authority as of February 11th, 2014, and the respective changes in financial position and budgetary comparison for the year that ended in conformity with generally accepted, or accounting principles generally accepted in the United States. The short version is that it is a unmodified opinion. There's actually been a couple of changes in semantics this year. If you look at the full independent auditor's report, you'll see that there's titles in front of the paragraphs, in front of the different sections explaining what those are. That's a change. Another change is that, as in the past, if you got an unqualified opinion, that means that your financial statements were fairly stated in accordance with generally accepted accounting principles. It's now called an unmodified opinion, which you did get. So it means that your financial statements and your footnotes are fairly stated in accordance with generally accepted accounting principles. With that, I'll turn it over to Tricia to go over some information on summarized information on financial statements. And again, if you see something that we don't cover that you have a question on, please feel free to stop us and ask a question.
Thank you. Again, my name is Tricia Floyd for the record. In front of you on the slide presentation, you can see that this is the government-wide statement of net position. The first slide lists out the assets. What I wanted to share before we go over the numbers in more detail is that, as I discussed last month, you have two sets of financial statements that are presented within your entire packet of audited financial statements. The first set of financial statements are on the full accrual basis. And full accrual means that everything has been brought to a long-term basis. So this is the statement that shows your capital assets. It shows depreciation. If you had debt, it would show debt, things of that nature. Then your second set of statements are on a modified accrual basis, and that is a near cash basis. So anything that would be realized within 60 days or within the next year. So any long-term items would not be included. There are also reconciliation schedules back and forth included in your large packet of the audited financial statements. So with that being said, what are the big things that happened this year? One of the bigger items was that there is now a blended component unit. This is the EDC, the Economic Development Council, has now been included within your financial statements. So that's something that has changed this year. You may not, when you look at the trend analysis over the past couple of years, you may not notice it because it was $250,000 worth of operating money. So it more hits the revenues and expenses, not necessarily the assets and liabilities. So, with that being said, now I'll go into what we have presented. This is different than what you've seen in previous years. We now have 5 years of audited data, so we thought it would be helpful to show trend analysis throughout the previous 5 years. So beginning in 2009, you'll notice that the total assets are about $4 million, and this consisted mainly of your inventories, which was the land out at the industrial park, and then there were some capital assets. That was the majority of your assets. There was some cash, but you can see it builds. 2010 was similar. 2011, we increased by approximately $5 million, and clearly it's in cash. And you all know, as you recall through the years, that was the first year that the Mosaic funds were received. In 2012 also, the Mosaic funds were received. And then in 2013, you'll notice it was a little bit more level, and that's because the Mosaic funds have been spent now. So as you receive new funds, the projects have been developed and they're well in line, I guess, in being executed. So that shows that. One thing I did want to talk a little bit more about on this slide is the inventory line item. Inventory and government, inventories, I guess, in a normal setting would consist of assets that you have for sale. And that's exactly what you have here, but in this specific organization, it's land held for sale. So that's something different than what a lot of other governments will have. So anything that is readily available for sale that is out in your industrial park is in your inventory line item. When it becomes a capital asset is when it has a building on it, or when you're renting out the building, when you're not intending to sell it, I guess, is the difference between when you delineate what is an inventory versus what is in capital assets. All right. The next slide shows your liabilities and your net position. Of course, your liabilities have been minimal. There's no debt, no long-term debt within your financial statements. You're clearly very liquid on the cash side. The accounts payable items are mainly due to the Economic Development Authority grants and projects that are going on at year end, so it's mainly a timing issue. And then you have your total net position. So as you can see, there's a very strong net position. You have $14.8 million. The categories that are required for the full accrual basis, which is what we're looking at here, are net position invested in capital assets. And this amount pretty much means it's your fixed asset number. So your capital asset number is restricted here. Then you have restricted for economic development of $3.6 million. This is what you have, which is largely made up of cash. This is what you have remaining in your Mosaic funds, your grant fund, and the remaining balance is unrestricted. Again, we are still on the government-wide statements. You can see that towards the top. This means we are still on full accrual basis, and we are showing the revenues and expenses here. And again, these go hand in hand. The revenues go hand in hand with as the years progress, with when the Mosaic dollars were received. So 2011, you can see a significant increase with the $6 million total revenues. And again, in 2012 and 2013 is slightly less because the Mosaic money went down by $1 million, according to the original agreement. Expenses vary from year to year, completely depending on what projects have been approved. I guess mainly what Mosaic dollar projects had been approved and what EDA funding had been received and spent during the year. So you can see it fluctuates from year to year. This is a recap of the previous slide, the total revenue expense, just to show your net position, your net change in position. And again, you can see over the years there's been significant increases, significant gains, and then losses. And in a for-profit company, you would normally think, oh, well, we had a loss this year. But the way you guys are structured, your revenue streams don't necessarily match the expenditures because you may approve a grant for $1 million or $1.5 million, and it takes a year for that project to really get moving. So that's similar to what you've seen here. So back in 2011, you had a lot of money to go ahead and award projects, and then in 2012, you can see the projects began. We had $3.2 million in expenses, and then in 2013, we had $5.6 million expenses. So you can see the projects that had been approved in previous years are starting to catch up. And also the $228,000 of a loss, because this is on a full accrual basis, it includes depreciation, and your depreciation number is really about $210,000, I believe, of the $228,000. So really, it's a non-cash loss, if that makes sense. All right, now I discussed the second set of financial statements, and this is the fund set of financial statements. So this is governmental funds. What this includes, right now you have 3 funds for the year 2013. You have the general fund, the special revenue fund for grants, and then the special revenue fund for the Economic Development Council. And this is on the modified accrual, so there will be no fixed assets. You'll see that the capital outlay is $2.5 million. In the previous statements, those were capital assets and on the balance sheet. And in these statements, they're treated as expenditures. So you'll see that the expenditures are higher on this set of financial statements. And just by the way, both sets are required according to the Government Accounting Standards Board. It's what every government is required to do. So as far as the trend analysis, you'll see again, I think the common trend is that the Mosaic dollars kicked in 2011, 2012, and 2013, and the expenditures have increased accordingly. There's been several capital projects you'll see in the capital outlay starting in 2010 and forward. So there's been a lot accomplished. This next slide breaks down just the revenue types on the modified accrual basis for 2013. You can see that the Mosaic funds are 65% of the total income, and the intergovernmental is the Economic Development Authority grants for 29%. Charges for services are represented by the rental income received from the buildings at the IDA Park and the rental homes on the Grove property and the Grove activity as well. Expenditures, there are only 2 categories of expenditures that are listed on your financial statements, and they are capital outlay for 34% and the general government economic development expenses, which is inclusive of everything else. So all the operations and so forth for 66%. And this is a recap of the total revenues, total expenditures, the net change in fund balance, again for the governmental funds on the modified accrual basis. You'll notice that there was, again, fluctuations between a net income or a net loss for the year. And as I stated before, this is highly dependent upon the projects that began in 2011 and then continued forward. And you'll see that you'll probably be asking, well, it was a $200,000 loss on the last set of financial statements, and now it's a $2.2 million loss, and that is specifically because of the capital assets. And again, there's a reconciliation schedule if you want to see those exact items within your large packet. The fund balance, this is a Government Accounting Standards Board, I guess it was GASB 54 standard that was implemented a few years ago. And they required that that the organization go through and classify what their fund balance is. I guess fund balance is one of those concepts that's probably a little harder to grasp. It's the equity component of your financial statements. And they wanted to have them in 5 categories, and you have 4 out of the 5 that are applicable to your statements. Non-spendable, that represents the inventory value, and that means out of your equity balance, this is non-spendable because it's in inventory. So you are not, the funds are not available for you to use. Restricted for economic development projects, the 3.6 million. This specifically relates to the funds in the Mosaic account. So this is everything from the Mosaic fund that's left over. So this is restricted funds that can only be used for economic development. You have an assigned balance, so this is anything that has been approved by the board, and then an unassigned, which is the remaining portion. For the past 2 years, management and the board has decided that it would be more accurate to present your financial statements with 2 funds at the modified accrual basis. So we have a general fund and then a special revenue fund for grants. And since we had 2 years of comparative data here, I went ahead and put this all on one slide for your revenues, expenditures, and then your net change and your excess of revenues over expenditures. So you can see just from a general fund standpoint that and this also includes the EDA grants. So you'll notice the intergovernmental is specifically EDA grants. The charges for services, again, as I had stated, relate to your rental income and your growth income. And there's some miscellaneous funds there as well. Then the economic development portion is mainly your operations and any growth expenses or related expenses of that nature. Capital outlay, and that is mainly, in this fund, it is mainly all EDA capital outlay related grants. This is a breakout of just the grant fund, which is your Mosaic dollars. And again, we had 2-year comparative data. So for the past 2 years, we've received Mosaic income. In 2013, it was $3.5 million. Again, this is less the $500,000 that goes to the BOCC. It's shown as a netted figure. So really, you had received $4 million, and then $500,000 went directly to the Board of County Commissioners. So your balance was $3.5. The general government relates to different projects that were not capital, and then you have capital outlay, which was your capital component, which was $1.2 million for the year. So you can see the expenses fluctuate greatly depending on what programs have been in place. And this is shown since the inception of receiving the Mosaic dollars as well. With that, I'm going to hand it back to Mr. Carter to go over the footnote disclosures.
All right, thank you, Tricia. Before I go on to the footnote disclosures, I'd like to make sure there's no questions on the numbers. Anybody have any questions on anything that Tricia talked about? Okay, if not, a couple of things in the footnotes that I'd like to emphasize. Last year, I'm sure all of you will remember, there was quite a discussion about whether IDA was a component unit of the BOCC. It was determined that yes, IDA is a component unit, a discretely presented component unit of the Board of County Commissioners. Well, this year, with the realignment of the boards between IDA and EDC, now EDC for 2013 has met the criteria to be treated as a blended component unit of IDA. Since you share the same boards, then that's one of the criteria that determine whether you're blended versus discretely presented. And really what that means is a blended component unit is treated as a fund of the primary government. So like Tricia pointed out, the EDC numbers have been blended in with the IDA numbers in your financial statements. So there is no discrete presentation of EDC. There were a couple of new accounting pronouncements. GASB 62 really, and GASB stands for Government Accounting Standards Board. GASB 62 really didn't have any effect on IDA this year. And GASB 63, the only real effect that had was some semantics. What used to be called net assets, which is your equity, in the full accrual statements is now called net position. So there really wasn't a whole lot of changes as far as accounting standards went. There is a new footnote this year. I know there was, the board's very familiar with the payment that was made to Rapid Systems. There was actually a note that was signed in case Rapid Systems is successful in their lawsuit and does get some money back from FERBA. And so that was recorded as a note receivable, but since there's no guarantee of collection, it was all allowed for. So on the face of your financial statements, it shows up as a zero. There is no asset there because it's completely allowed for, but it is in the footnote to show that there is still a note that exists.
Mike,
Yes.
does that mean we're not going to try to collect it?
No, that means that if they are successful in the lawsuit and they do get reimbursed the money, then you're due back a portion or all of the $127,000.
Okay, so it's not just going away.
No, but it's not shown as an asset on your books. It's a legal document and you do have a claim, but there's no guarantee that they first will be successful and second that FERBA will have any money to pay them back. So that's why it's been fully allowed for.
Well, that's what had me confused when it said it's been deemed uncollectible.
That's just being conservative. And instead of showing an asset on your books that you really may not actually have any value.
And I guess what confused me is in this, that's not easy to do, by the way, it's confused me. It's not hard to do. I can be fooled pretty easy.
Well, that's why they came out with the clarity standards in accounting. We're trying to make all this as clear as possible. So.
All right, well, on the sheet that I got in here, and it's hard for me to see without light. The more light I got, the better I can see. It's got $200 and something thousand instead of $127,000 on this draft.
That's just the total of the adjustment. And the adjustment has a note receivable Rapid Systems and then a bad debt expense. And then this is basically two adjustments combined into one.
Why wouldn't you put just zero if it balanced itself out?
Well, that's what the effect of that adjustment is. It zeroes it out, but it's really two transactions. One, you put the note on the books, and then second, you report the allowance for doubtful accounts.
Well, Mike, why does it say total 200 and I can't read that 56,000 or whatever it is?
That's mainly an accounting thing to make sure that your debits and your credits balance. You total them up on your adjustments. Anytime you do an adjustment, you make sure that your debits equal your credits, so
Okay,
everything balances.
I'll accept that. Because I don't know, that's for sure.
On the next slide, note 5 is a related party disclosure. And for this year, it was the expenditures to Continuum because of the various relationships was put on there just for full disclosure as a related party transaction, as well as the accounts payable at the end of the year. The next slide, also on the related parties, because IDA is a component unit of the Board of County Commissioners, and because EDC is a component unit of IDA, the transactions between those three entities are shown in the related parties footnote. And then also disclose that the cash account is in a financial institution where there's a board member. So that was all the related party transactions that we were aware of.
What about the PF Man thing?
Is that a related party transaction?
Well, it's right under the one for, the last one I showed you for Rapid System.
I'm sorry?
Yeah, it's right here.
I will address this in once the presentation is finished with financial statements, I'm gonna go over this
Okay.
specifically. But
Yeah, I
it
think-
really doesn't have, it's not a related party though, so I don't think it relates to what's on the screen.
I think that's something that's different, Donald. That's,
Okay, well, it was stuck in here right behind the,
Yes.
so, okay.
Tricia did that on purpose to try to.
She's after me.
So, finally, the next, on note 8, is a list of the commitments that the IDA has made so far. And that's just, those haven't been incurred yet, but that at least gives you an idea of the total equity and the total assets that are available. This amount has been committed for future projects. There's also 2 other reports that we're required to issue. One is the report on internal control over financial reporting and compliance and other matters that's required by government auditing standards. And what that does is it charges us with during our audit, if we find conditions that have a significant effect or a material effect on your financial statements, whether it's in the internal control area or in the compliance area, then it would go on this report. And there were 2 findings that we had, and that's back in your financial statements on pages. Yep. Pages it goes on. Pages 32 and 33. Actually 32. One was had to do with formal written policies over information technology, and we're just recommending that some tighter general controls and application controls be put in place as far as password protection and changing of the passwords, that sort of thing, just to keep the information more secure. And also, there was a report on, a finding on the timely repayment of the due to FRUMs. If you look on the financial statements, between the general fund and the special revenue fund, there is $346,000 that's due from the general fund to the special revenue fund. That had to do with prior year advances. And we're just saying that the general fund has $1.4 million in cash, so just go ahead and we're recommending you just go ahead and take care of that due from. And just make sure the money's in the right pot. Also, the Auditor General requires that we issue a management letter. And there are certain things that are required to be addressed on the management letter. Actually, we'll go to the first item that's required on the next slide, but the first thing that's required is that we address any findings that were in the prior year. And this is a list of the findings that were in prior years. And you can see that the IDA has made some substantial changes during the year. Probably the biggest one was brought in an outside accounting firm. And so the accounting was done properly year end. When we came in, there were no significant adjustments that were recommended. There are no material adjustments, no prior period adjustments. The financial statements were prepared, so that took care of the first set of probably the first 4 findings. And the IDA has also you've done a good job in developing formal policies Some of these go back to a couple of years ago when proper filings hadn't been done. That's all taken care of and you're up to date as far as the filings with the state. And as far as what we saw down the third from the bottom, lack of supporting documentation, that goes back a couple of years. We haven't found that. We found documentation for everything that we looked at in the audit this year. We also saw that the transfers between funds were properly reported as opposed to prior years where there have been some issues there. So, John, did you have a question?
No, just.
Oh, okay. And then the Property Owners Association really hasn't been an issue for a couple of years. The Auditor General requires us to go back 2 years and show the findings for the last 2 years. And if those have not been addressed, then you'll be getting a letter from the Joint Legislative Audit Committee asking what you're going to do about the open comments. But as you can see, you have addressed everything that was open in the past. Also, the Auditor General requires that we address whether you've invested public funds properly and you have invested your excess cash in accordance with Florida statutes. The non-compliance, we did leave that comment in there from last year. The Auditor General did have 10 findings in their operational audit that are still on their website, and they will be coming back 18 months after that report was issued, which was about a year ago. So sometime probably later on this year, they'll be coming back to see the progress that's been made on those 10 findings. And we left reference to that report in the management letter. And then financial condition assessment, we're required to assess whether you have a declining financial condition. And as you saw with Tricia's presentation, your financial condition is very strong. So that's not an issue. Any questions on the reports, the other reports that we issued?
Yeah. Page 3. Can you tell me what that last paragraph says?
Page 3?
Yes, 3 at the top. It's 3. It says other information, the documents. Right there. It says page 3.
We didn't get to this letter yet. One more slide. One more slide.
This thing is so confusing to me.
Sorry.
It's part
You're
of the.
stealing my thunder. I get to close.
Oh, you're gonna do this.
Sir.
Yeah. Well, that is, if there's no questions on what's been presented so far, the last thing that we are required to issue is required communications with those in charge of governance. That's the separate letter that you have in front of you. And I will turn it over to Tricia to go over the required communications.
Thank you. All right, so this letter, I think you probably all have it in front of you in draft form. As Mike stated, this letter is required by accounting standards, and it is required to be communicated to those charged with governance, which is the board of directors. So we are required to report on, if you'll follow the headers along the circle here, we have significant audit findings, which are things significant within the audit. Accounting policies, we had, as Mike discussed, we had GASB 62 and GASB 63 that were implemented this year. GASB 62 were some standards that didn't really have much effect on your statements. GASB 63 was the wording change between net assets to net positions, so there really was not much of an effect with that. Page 2 of this letter talks about accounting estimates. So we go in detail and we look at the estimates that management has given us or provided us and make sure that they are in accordance with generally accepted accounting principles. We had an estimate on inventory valuation, and this would be the fair market value of the property that's held within your inventory. Inventory by accounting standards is required to be reported at lower of cost or market. So that is an assumption by management as to what the fair market value of your land is that's out at the industrial park. We have management's estimate of allowance for doubtful accounts, and this specifically related to the note receivable that we talked about earlier in the slide that was allowed for. And then management's estimate of useful lives over the fixed assets or the capital assets, and that is a depreciation calculation. Those of you that are familiar with this, it's the term where they capitalize it and then they take the balance and they amortize it or straight line depreciate it over X amount of years. So the number of years is an estimate, and of course there's guidelines and rules for what is acceptable within accounting guidelines. The next bullet point is financial statement disclosures. It goes over any difficulties encountered performing the audit, and we had no difficulties. Any uncorrected and corrected misstatements. And again, these are terms that I don't really like, but the clarity standards are trying to make it more clear. The uncorrected misstatements, which is the page that you were referring to earlier. Uncorrected misstatements are misstatements that we come across that may be due to minor areas that we don't believe would affect the opinion of the users, but of the financial statements. So in this instance, you can see in the attachment, the last 2 pages actually are 2 pages of journal entries listed. There's attachment A, which is past adjusting journal entries, and attachment B, which is adjusting journal entries. The uncorrected journal entries are journal entries that we've passed on. We've said for one reason or another that we don't feel like it's going to affect the users of the financial statements, so we're going to pass on making the adjustment. So we've noted it. Our requirement is that we inform you that we've looked at these and we've decided that they are not material. So the first one was listed there, and that has to do with PFM. So I think that was one of your questions. The second one listed has to do with depreciation, specifically on the broadband equipment, both of which have been passed on. So we have determined that it's not something that we need to report.
You talking about the PF-MAN thing?
Yes.
Okay, my question is, do they owe us that money?
Bill, they do, right?
I think it was, we received payment after September 30th.
Correct.
So it was due at the time of the audit, but they have paid that money.
So it was more of an accounting adjustment just to reflect it
Okay.
as a timing issue.
That was my question. I guess it was mainly to staff more than it was to you, because I just, it just says it's like the rapid systems thing, Okay,
Okay,
all right.
all right.
I got a question.
Sure.
You say they have paid that money? Is there a person associated with they?
PF-MAN paid that money. I don't know exactly who wrote the check.
You don't know that?
I mean, we can find
That's
that
okay.
out. Certainly don't mind producing it.
Okay, the next is the corrected misstatements, so that's attachment B. And that specifically is the other question that you had addressed earlier during the presentation. This is the treatment, as Mike explained, this is the treatment of the accounting side of how we recorded the note receivable and then the allowance for it. So, does that make sense?
Some of it does. Some of this stuff bothers me. It says in here, because these limited procedures do not provide sufficient evidence. We did not express, I can't hardly read this, it's too dark, an opinion or provide any assurance on the RSI. That concerns me. I mean, I don't understand all this stuff about. So when I read things like assumptions and estimates, and we weren't given evidence or something, I'm just curious about it.
Unfortunately, that's standard wording. RSI stands for Required Supplementary Information.
Right.
And that is the management's discussion and analysis. Basically, that's like it says, it's management's discussion and analysis. It's management's responsibility to provide that. And all we're saying is that wasn't part of our audit. That's not included in the definition of financial statements, and that we're not taking any responsibility for the management's discussion.
Who decides what is part of the audit?
The accounting and auditing standards decide that.
Okay.
And as far as the way that I don't want to get too deep into which
Well, I wish
statements,
you
but-
would.
Okay, GASB 34 is what reconstructed the whole set of financial statements for governments and required management's discussion and analysis. And GASB 34 states that that's required supplementary information, but it's not part of the basic financial statements.
Okay.
So,
Okay.
To clarify that, the management discussion analysis of your packet of financial statements is pages 3 through 11. That's the specific portion that we were referring to in that paragraph.
yeah, And Donald, that's kind of boilerplate language. You'll see that in every audit report on government. That's not something that's unique to IDA.
I certainly can't dispute you.
I could provide plenty of examples for you.
I wouldn't know what you were talking about, probably.
All right, going back to the letter, we also cover disagreements with management. We had no disagreements with management. The top of the next page talks about management representations, and there's a management representation letter, and that letter is signed by management and usually the chair of the board. And that goes through and states that everything that management and the board provided us, everything that there was available for the audit, things of that nature. So that should be signed today, and that should, once the audit has been accepted at the board meeting, and that will finalize the audit report. Management consultations with other independent accountants. We are not aware of any second opinions. They have hired Wicks Brown, but besides that, we're not aware of anything. They haven't communicated that there were any issues. Significant issues discussed with management prior to the engagement. We are not aware of anything that would be significant. Other than what we've noted, there are no other audit findings or issues. And I believe that the last paragraph of that talks about the other information, which is the RSI, and that's what we had just gone over. Explaining that RSI is the management's discussion analysis, which is pages 3 through 11 within the financial statements. And with that concludes our presentation. So
I got some
we
more.
thank you very much for the opportunity to serve you, and we would be happy to entertain questions.